The Maldives is one of the most exclusive resort destinations in the world. Located in the Indian Ocean, southwest of Sri Lanka and India, this island nation is made up of nearly 1,200 coral islands grouped into 26 atolls. With its turquoise lagoons, white sand beaches, and iconic overwater villas, the Maldives has positioned itself as a premium luxury tourism market. But beyond being a dream vacation destination, the Maldives represents a unique and high-barrier real estate and hospitality investment opportunity. In this video, we will explore how resort investment in the Maldives works, the ownership structure, capital requirements, potential returns, major risks, and long-term outlook. First, it is important to understand that the Maldives does not operate like traditional property markets in Europe, North America, or Asia. Foreign investors generally cannot purchase land on a freehold basis. Instead, resort investments are structured through long-term lease agreements with the Maldivian government. These leases typically range from 50 to 99 years. In practical terms, investors lease an entire island from the government and develop it into a resort. The lease grants development and operational rights, but the underlying land remains state-owned. At the end of the lease term, ownership reverts back to the government unless extended under new agreements. Therefore, Maldives resort investment is not about permanent land ownership. It is about securing long-term operational control within a structured regulatory framework. There are three primary ways investors enter the Maldives resort market. The first pathway is full-scale resort development. This involves securing a government lease for an undeveloped island and building a luxury resort from the ground up. Development costs typically start around $50 million and can exceed $300 million for larger or ultra-luxury projects. These costs include construction of villas, restaurants, spas, staff housing, and recreational facilities. Infrastructure costs are significant. Because each island operates independently, developers must build their own power generation systems, desalination plants for fresh water, sewage treatment facilities, waste management systems, and docking infrastructure for boats and seaplanes. Logistics are complex, as most construction materials, equipment, and furnishings must be imported. The second pathway is boutique or mid-scale island development. These projects typically range between $10 million and $50 million. Boutique resorts may include 20 to 40 villas and often focus on eco-luxury, wellness tourism, or hyper-private experiences. Smaller resorts can operate with leaner structures and may achieve high nightly rates by targeting niche luxury segments. The third pathway is structured investment. Instead of directly developing an island, investors can participate through hospitality funds, joint ventures, or private equity placements. These structures pool capital to develop or acquire resorts. Minimum investment thresholds vary widely, but may begin at several $100,000 for structured offerings and higher for private placements targeting accredited or institutional investors. Now let us examine revenue potential. The Maldives operates in the premium and ultra-luxury tourism segment. Average daily rates at five-star resorts commonly range between $800 and $2,500 per night. Some ultra-luxury properties charge significantly more for exclusive villas. Occupancy rates vary seasonally. Peak season typically runs from November through April, when weather conditions are dry and favorable. During these months, occupancy can be very strong. The off-peak season sees lower occupancy, but often remains profitable for well-managed resorts. Revenue is driven by room rates, food and beverage sales, spa services, excursions, and premium experiences. High-end guests often spend significantly beyond room costs, increasing total revenue per visitor. In terms of returns, well-performing Maldives resorts may generate internal rates of return between 8% and 15% annually, depending on financing structure, brand positioning, and operational efficiency. EBITDA margins can be attractive in strong tourism cycles. Additionally, successful resorts may appreciate in value, creating exit opportunities through resale to larger hospitality groups or private equity firms. Brand partnerships play a major role in performance. Many resorts operate under management agreements with international hospitality brands, such as Marriott, Hilton, Four Seasons, or other luxury operators. A recognized global brand can enhance pricing power, marketing reach, and occupancy stability. However, it is essential to understand the risks. First, climate risk. The Maldives is one of the lowest-lying countries in the world, with much of its land only 1 to 2 meters above sea level. Rising sea levels, coral bleaching, and extreme weather events pose long-term environmental concerns. Investors must consider sustainability and resilience strategies, including elevated construction and coastal protection. Second, operational costs. Running a resort in the Maldives is expensive. Nearly all food, beverages, construction materials, fuel, and consumer goods must be imported. Transportation costs are high, especially for remote islands requiring seaplane transfers. Staffing also requires careful management with both local and international employees. Third, tourism dependency. The Maldives' economy relies heavily on international tourism. Global recessions, pandemics, geopolitical tensions, or airline disruptions can significantly impact visitor numbers. The COVID-19 pandemic demonstrated how quickly international travel can decline, directly affecting resort revenue. Fourth, regulatory and political risk. Although the Maldives has maintained a relatively investor-friendly approach to tourism development, government policies, tax structures, or lease terms can evolve. Investors must conduct thorough legal due diligence and maintain strong compliance practices. Fifth, financing and liquidity risk. Because resort investments require substantial capital and are operationally intensive, they are less liquid than traditional residential or commercial real estate. Exit strategies often depend on finding institutional buyers or hospitality operators. Despite these risks, the Maldives remains attractive for several reasons. Global demand for luxury travel continues to grow, especially among high-net-worth individuals from Europe, the Middle East, China, and the United States. The Maldives has built a powerful global brand associated with exclusivity and privacy. Limited land supply creates scarcity, which can support long-term pricing power. Additionally, the government continues to invest in infrastructure, including airport expansions and improved transport connectivity. Enhanced accessibility may strengthen future tourism demand. Emerging trends in Maldives resort investment include eco-sustainable development, renewable energy integration, and wellness-focused concepts. Investors are increasingly incorporating solar power systems, coral restoration initiatives, and environmentally conscious architecture. Sustainability is becoming both a marketing advantage and a long-term risk mitigation strategy. Another trend is ultra-private, high-margin villa concepts targeting ultra-high net worth individuals seeking privacy and exclusivity. These developments often include large standalone villas, private pools, dedicated butler service, and curated experiences. In conclusion, resort investment opportunities in the Maldives represent a unique blend of real estate development and hospitality private equity. This market requires substantial capital, operational expertise, and a long-term perspective. It is not passive property ownership. It is an active, management-driven investment tied closely to global tourism dynamics. For experienced investors who understand hospitality operations and are comfortable with elevated risk profiles, the Maldives offers access to one of the most prestigious luxury tourism markets in the world. With strong brand recognition, high nightly rates, and limited supply of developable islands, it remains a distinctive and potentially rewarding investment environment. As with any major investment decision, careful due diligence, legal structuring, environmental assessment, and financial modeling are essential before committing capital. The Maldives is not simply a beautiful destination. It is a specialized investment landscape that combines opportunity, complexity, and global luxury appeal.